Ashwini, hi, morning. Good to have you on the show. What's disappointing the markets? We've got vaccine for all 18 plus come May 1st. Is it the localized lockdowns and curbs which is bogging the sentiment lower?
Yeah, Aisha, I mean, if you think about it, the September quarter and the December quarter earnings led to a massive upgrade to future forward-looking estimates. And obviously, the sense one gets is that it will be very difficult for anybody to be more optimistic about earnings going ahead, because while the lockdowns are localized and the impact is not as deep as what we had during the national lockdown last year, it's fair to say that there will be certain activities that will take the back seat. Given how widespread the second wave is, it's obviously causing a lot of disruption to families and incomes of those that are affected, as well as those businesses which have been forced to shut down again. So I think earnings upgrades are missing. Valuations had become a little on the richer side towards the middle of February. So these two concerns have come together in an environment where the US dollar has appreciated despite whatever fiscal deficit and the stimulus that the US economy is providing has been provided, and in spite of the fact that one was hoping to see more traction on foreign inflows this year, given that emerging markets should be posting a sustained growth over the next 3 to 5 years, given how low real rates are. So I think the longer term story remains intact. I think in the short run, there is little room for earnings to surprise on the positive side, and I think there is a little bit of worry that demand conditions might remain weak for another couple of months. So that's taking its toll as we speak.
So, I mean, net, Ashwini, are we back to square one, exactly where we started off same time last year? Is it now only going to be medical news which the market is going to track and rebound from these lows? Or is there anything else which could act as a trigger, perhaps, to change the sentiment?
No. I don't think things are as uncertain as they were back in April last year. See, remember, April last year, we didn't know what this virus is all about. We were in a national lockdown. We had no idea when things would come back to normal, and so on and so forth. This time around, we know that the vaccine works. We know that the vaccine acceleration is happening. We know that these waves will come and go as they have in other parts of the world. So I think there is a definite certainty this time around as compared to the last time around. The other thing is that, the government has realized that a national lockdown or any extensive or long-held lockdown is very detrimental for the economy. So notwithstanding what they're trying to do to curb the spread of the infection, they're trying to keep as many things open as possible. So I don't think it's going to be as bad as the last time around. It's not as uncertain as it was the last time around. But for a positive trigger, you obviously need the second wave to start coming off. That definitely needs to happen. Purely from a sentiment perspective, and I think we need to go through the earnings commentaries and let's see what people say. I'm hoping that at least whatever conversations we had with our holdings around mid-March, people seem reasonably confident that there might be a little bit of a hiccup for half a quarter or a quarter, but things are on track. I think the good news, is that balance sheets are very healthy, both in the corporate world and in the financial world. I think real rates will remain low for a long time, which is what RBI has committed to. And that should ensure that there is a very strong recovery going ahead. So, we just have to kind of hang on and go through this little bit of an air pocket. But I don't think it's as uncertain or as bleak as it was the same time last year.
Ashwini, the market narrative, and I'll ask you both the questions. First, the market narrative before the first of all before the second wave struck us or hit us, let's say in March middle was, the run-up was strong and the markets were due for a correction. And markets were running ahead of themselves. Now that the second wave has struck us, and if one imagines also that the second wave will get soon and things will normalize, what is the upside for markets to go higher? Because without the second wave also this market was expensive. Now with the second wave, whenever it normalizes on the medical front also, the valuation headroom is still missing.
So, Nikunj, I don't disagree with you on the broad Nifty index, if that's what you're talking about. But, it's a tale of two cities inside the index, right? There are a bunch of stocks which are still fairly inexpensive, and there are a bunch of stocks which are very, very expensive, and they have been expensive for the last, 3-4 years. The classic sort of perpetual growth stories, if I may use that term. So I think that there is a fair chance that the rotation that we are seeing for the last few months may continue, where people may position themselves more towards emerging areas of growth at cheaper valuations as compared to assured areas of growth at expensive valuations. So it is quite possible that you don't see much upside in the Nifty per se. But I think, bottom up, there will be a lot of opportunities. I mean, you think about it this way, right? If you look at Nifty year to date, it's flat. And there are stocks which are up 50-60%, and there are stocks which are down 20% within the Nifty. Okay, so I think the reality I would like to focus on is the fact that the government is very, very keen to drive economic growth. They're doing whatever they can. The Reserve Bank is keeping rates low. There is no leverage in the system, and therefore all the ingredients for a sustained growth are in place. So I think, that is the narrative which will hold. And, whether the Nifty goes up a lot or not, to my mind, is less relevant. But is there an opportunity for investors to do well is the real question. And I think that opportunity exists from a 1 year perspective, or, possibly even a 6-9 month perspective.
By and large, fully invested, are you using every decline to put the money which you had in your portfolio?
Yeah, we remain fully invested because as institutional investors, we see ourselves as not as asset allocators, but as somebody who's managing an equity exposure of a client. So it doesn't make sense for us to make significant cash calls. So as a pure discipline, we never do that. We tend to remain, nearly fully invested. A few percentage of cash maybe here or there for, when you're migrating from one position to another, but that's about it. So to answer your question slightly differently, there are changes that we are making to the portfolio, taking advantage of the declines where we feel more confident and where we feel valuations are supportive. We are putting more money to work, taking it off from areas which have done relatively well and where we see more headwinds emerging.
Could you be slightly more descriptive about that where you think that it's time to increase allocation and where do you think it's time to take the chips off the table?
So, okay, let's talk about a few sectors, right? So if you look at IT services, the valuations are reasonably rich. There are headwinds emerging in terms of higher wage costs. The kind of tailwinds that all these businesses received from no travel expense, not having to run their operational facilities, so the overheads relating to running those operational facilities weren't there. Wage increases were fairly subdued over the last 1 year. Utilization went up, offshoring went up. So, everything that could go right over the last 12 to 15 months has gone right for them. And now you're starting to see some of these pressures build up. I'm not worried about revenue growth here, but I think on the margin side, there is really no room for the margins to expand. So earnings growth should mirror more or less what the top line does. A joker in the pack here would be the significant weakness in the INR versus the US dollar. We don't think that should be an outcome, but if you want to play that, that's a different story. But otherwise, I think that that's a sector that's getting fairly pricey. And we've been very positive on IT services for a couple of years. So now I find the valuations to be a little challenging for my taste. We've been away from consumer stocks for a while, and I think both staples as well as many consumer durables stocks are looking very, very expensive. They have looked expensive for a while, and I think this rotation into value, which is a global trade, mind you, will happen in India as well. So that's those are some of the other sectors where one has to be cautious. I mean, I still like the financials. They've taken it on the chin from the middle of February, and many stocks are down whatever 25% or thereabouts from the recent peaks. But if you think about it, there is the balance sheets are clean. Everybody has raised capital. There might be some incremental stress, but it's unlikely to come from the corporate side. It might be there in MSME to a small degree. It might be there in retail loans to a small degree, but I don't think it's anything that the banks can't handle. And they're all very well capitalized. So I think, that's one sector which is looking reasonably interesting. I think on the construction side, on many of the domestic local demand drivers on the industrial side, there are many bottom-up opportunities that look interesting. I have not personally been able to convince myself to invest in materials because there are far too many global moving parts which I am not able to predict. But, a lot of people are continuing to be very positive there, and valuations are not expensive. So if steel prices, for example, continue to remain solid, valuations are not expensive. Most of the companies are deleveraging. So, those stocks still might have some room to go. So there are plenty of places where you can look for opportunities versus, places where stocks are safe and good, but valuations don't really leave much room on the upside.
Ashwini, what's the view then on the headline inflation, the potential input price rise impacting the consumption sector? And do you think that as we gradually down the line see the economy opening up and, recovery kicking in, there will be, strong recovery within this space?
If you're talking about risk of higher inflation, if I understand your question, I think, one key input for inflation is wages. And with the kind of unemployment and drawdown in personal savings you have seen, especially at the lower end of the pyramid, I don't think there is any significant wage pressure in the economy. IT services is a microcosm of that, where you need a significant amount of skill and labor is not fungible. So let's leave that out. But if you talk about manufacturing, if you talk about general feet on the street, if you talk about construction labor, etc., I don't think there is any wage inflation in the offing. Also, there are certain base effects that will start to kick in, and my sense is inflation should remain fairly range bound. I tend to agree with what Reserve Bank of India put out in its credit policy earlier this month, that somewhere in the region of 5.5% CPI looks possible. I mean, on the food side, if you go by what IMD has said, that there should be a third successive good monsoon. I think on the food inflation side, also we should be reasonably okay. Material input costs, yes, you might see some lift from there, and you might see some lift from energy. But let's see how that plays itself out, because, like I said, there are as many supply issues there as there are demand issues, and supply issues in the sense that a lot of companies globally, whether they were mining companies, whether they were metal producers, whether they were or whether it's shipping, honestly, all have been supply constrained, and gradually as economies open up, supply will also come back. The resurgence of wave 2 and wave 3 in various parts of the world also tells us that demand should be a little bit weaker than what we were thinking 3 months ago. So I don't know. Let's see how this plays out. Like I said, on these metal prices, I really can't forecast them. I've never been able to. So I'm possibly the wrong person to predict this. But overall, my sense is inflation as a risk is not there. I mean, the worry that one can potentially have for the Indian economy is that if inflation goes up and growth goes down, Are we staring at yet another stagflation type environment, which India has suffered in the past? This time around, my sense is that there is enough room to grow. Balance sheets are in good shape. And because wage pressures are not there, unemployment is fairly high, my hope is that the inflation would be manageable. Of course, crude oil prices can play a spoil sport. We have to see how that pans out.
How long? I just want to mark the markets right now because the fall is rather rapid as we're on the brink of breaching 14,200 as well on the downside. Incidentally, we've hit the lowest level since the 1st of Feb, given this massive cut that we've seen in the markets. In fact, the Sensex as well down about 340 points. Banks, a huge casualty in trade this morning, having shaved off about 1% or so, 300 points. Auto, FMCG as well, not lending a helping hand. Infrastructure as well as real estate, those are some of the sectors that have been impacted. The broader markets as well, while the small caps are holding out in the green, it's a cut of about 0.2% on the mid caps. Names like Indocent, HUL, Axis Bank and Tech Mahindra, they're currently in the red. Curious, Ashwini, as to what your outlook is when it comes to the recent spate of IPOs as well that have hit the markets. Quite a bit of non-conventional names as well that have come into the market, playing the overall digitization play, etc. How have you looked at the recent spate of companies that have hit the markets for listing, and is there anything in particular that catches your eye?
See, there are two questions embedded there, and let me separate them. One is demand and supply of paper. So typically, when markets are very strong, supply of paper increases, and usually the market tops are accompanied by buyers stepping away and lower quality issuances increasing at the margin. So that's a typical development at the top of the market. This time around, if you think about it, most of the issuances are unique, as you mentioned. Some of them are in areas which were not open or not available in the public investing space. Many of them are really, really good businesses, very well managed, with high return ratios, with responsible management in place, and so on. So I think the quality of the IPO issuances has been very strong, and I think investors have been very discerning, and I think there have been attempts for IPOs that haven't gone through because investors have stepped away because the asking price was too high, or because the business outlook was unclear. So I think the first question is that from a supply of paper, yes, supply has increased and demand has abated at the same time. So one needs to be a little careful if the IPO pricing is aggressive and there is no money on the table. But on the second side, if there are unique businesses with unique opportunities, they might still offer upside. But you have to be cautious about the pricing, because I don't think this is a time to be very cavalier, about valuations. I don't think one can throw it to the winds. So I like many of the issuances that have happened in the recent past. We participated in some of them for sure. And I hope these companies will do really well as we go along. And I think a good quality issuance always raises the bar and raises the game, a standard of play for other listed companies. So it's always a welcome thing in my view.
Buying some of the COVID-hit businesses, airlines, multiplexes, restaurants, some of these companies will not shut down. Indian Hotels, Indigo, they're backed by a strong group, strong cash flows, but the markets are believing that it's the end of the business it's the end of the franchise value and the terminal value, and that's how the stocks are falling.
Yeah, Nikunj, this is really value investing, right? And value investing is never fun. It's very painful. So if you believe that, there are businesses out there in retail, in entertainment, in travel and tourism, in hospitality, which will survive and they will emerge stronger because the competition will be weaker. These kind of times are the times when you buy these stocks. Now, you buy them in the knowledge that you might see another 20% down before the stock bottoms out, and you might have to wait for a year to make any money. And that's the patience that value investing requires. So, unfortunately, what happens is in the short run, the immediate returns or the prospect of immediate losses kind of offsets the upside potential in the long run. And people say, "Oh well, what's the rush? Let the data points emerge, and we look at it then." It's a very different ball game. It's very tough to look past the immediate issues at hand, immediate risks at hand, and focus on the long term. But crisis is always a great time to be buying a good business. Whenever a good, strong business goes through a crisis, history tells us that's been a great time to make a long-term commitment to that investment. But be prepared for seeing a little bit of red ink and be prepared to hold on. That's what I would say to investors. It's not something that you should attempt trading for sure.
What is that contra value pocket according to you? Because this market is not at 7,000 or 8,000 in Nifty. We are at 14,000. So you're talking about contra and smelling an opportunity. What is the deep contra bet where the downside could be 15-20%, but in 3 years the upside is coming?
Well, the entire financials basket. I think, Nikunj, think about it. Okay. All these stocks are trading at, big book value. Let's leave out, the top 3-4 banks. Okay. We'll come to them later. Otherwise, the entire lending space is trading at book value, give or take. Okay. There is a big section of the lending world which will not be able to participate in the growth because they don't have the capital. I'm talking about the PSU banks, barring State Bank of India and possibly Bank of Baroda. Right? Growth opportunity is phenomenal for all these lenders. All of them have come up the curve on technology. Most of them have come up the curve on technology. Most of them have the capital to grow. This is an absolutely simple, investable place for somebody looking for value. Now, the problem is this. The problem is that the bank Nifty or the banking stocks as a basket is the favorite playground for short-term speculation. So if somebody wants to, and it has high beta, right? So if you are negative on India and you say that, well, India is seeing these COVID cases and foreign investors are going to be scared and the rupee is going to go down, let me find something to short. So here is a place where there is liquidity, there is high beta, and you short it. And that's what you're seeing. But from a medium-term perspective, and I'm not even saying long-term, I'm saying medium-term perspective, these stocks are very, very well positioned for growth. The only long-term risk is, can technology completely disrupt these businesses? We'll see how that happens. We'll have to see how that unfolds because India is also very deeply regulated. It's not easy for many fintechs to do exactly everything they want. Yes, that risk is there at the back of my mind and we watch it very carefully, but I don't think that's a big enough disruption for us to walk away from the sector completely. So, since you said that, what is one place where you would like to, point out, this is one place. Other places, if you are in a market leader in, let's say, a transportation airlines business or in a restaurant, in a hotels company, or even on retail chains which are financially sound, you can make long-term commitments to these names in environments like this, and you'll come out ahead because this is the time to make a commitment and hope for a 30-40% return over the next 1.5 years, which is not a bad return to make. But yes, be prepared for a 10-15% loss potentially, and be prepared to hold for that time period.
Well, Ashwini, really appreciate your time. Thank you for your candid Phil, thank you for a candid chat, and stay safe, my friend. Thank you very much once again.